Assalamu alaikum. Good afternoon, audience. Yesterday we did CGT, capital gain tax, chargeable gain tax, right? Our today's topic is inheritance tax and value added tax, right? Okay, this is the day 2 of P2P revision webinars, right? Now, first we'll cover inheritance tax and then we'll move on to value added tax, okay, right? You all know IHT is not an income tax, it's a wealth tax. It's a wealth tax, right? And IHT is normally computed on transfer of wealth, Now, how we gonna compute? Gonna compute amount of IHT payable, amount on which amount do IHT is payable? So normally you might have studied this. Listen, IHT is computed on decrease in wealth of donor. Now listen. There are two people. One is donor and the other guy is donee, right? Donor is giving gift and the donee is receiving gift. But what's the law? The law is IHT is calculated on decrease in wealth of donor, not increase in wealth of donee. But a student can ask, sir, if you are giving this pen to your son, so this pen is going out of your pocket and this pen is going inside the pocket of the son. So the increase in wealth of donee equals decrease in the wealth of donor. Yes, in this case you are right, but not always. You might have heard about the example of the pair of shoe. If the pair of shoe is combined, the value is different. But if I do it separate, like right shoe and left shoe is separate, so the value is definitely different, right? So that's why tax department has made this law that IHT is calculated on decrease in wealth of donor. Now, how do we calculate this decrease in wealth of donor? Now, listen very carefully. Listen. First of all, just think that donor has not given any gift. Donor has not given any gift. Now calculate the value of that gift. So what is it? Wealth of donor before gift. First you will calculate this amount, wealth of donor before gift, and then after giving, after giving the gift, now what else is left with you? After giving the gift, what else is left with the donor? Calculate the value of that amount, right? So less wealth of donor after gift. When you take the difference of these two, you will come to decrease in wealth of donor, right? Now, normally in past papers I have given the example of pair of shoes, but in past paper normally this example come with shares. And you all know this, that combined shares, the 100%, 80% shares have different value, and if you break it up like in 40%, 30%, 10%, the value is different, right? Okay, so you have to apply this formula, wealth of donor before gift less wealth of donor after gift. Now, one more thing, in today's past papers we'll also cover this area practically as well. Okay, so don't forget this is a very basic thing, and normally examiner ask about this also, right? Now, moving forward to next slide. Now, very important, IHT is calculated on normally two things. Number one, lifetime gifts, and number two, death state. Lifetime gifts and death state. Lifetime gifts means you have given a gift to your son or your daughter or anybody permanently, forever. So this is called lifetime gifts, and lifetime gifts are given when you are alive. Now, what is death state? Death state means, let us say a person has just died, and whatever is left with him or her, that's total amount is death state. So IHT is not only applicable on death state but also on lifetime gifts, right? Okay, so there are two major lifetime gifts. The first we are going to cover the lifetime gifts. The first gift we call it PET, and the full form is potentially exempt transfer. Now, sir, what is potentially exempt transfer? Gift to any person. One person gives gift to another person, that is PAT, that is potentially exempt from IHT point of view. Sir, what does it mean? It means in the year of gift, let us say I have given gift to my son in 15-16 fiscal year. I have given gift to my son in 15-16 fiscal year. I have given him a car or anything, right? So right now in the year of gift, there is no tax at all. There is no tax, no IHT at all, no IHT implication, even no calculation at all, right? But if the donor died, read it. If donor died within 7 years from the date of gift, then this pat will be chargeable. Then this pat will be chargeable in the year of death. Then this pat will be chargeable in the year of death. Okay, so don't forget what is how will you recognize pat in the exam. One person giving gift to another person, one person giving gift to another person is pat. And in the year of gift of pat, there is no IHT, no IHT implications, even no calculation. But if donor died within 7 years, then this pat is chargeable in the year of death. Okay, now one very important concept: market value of gift. Market value of gift locked at the time of gift. For example, i have given I have given a property to my son in 15-16. I have given a property to my son in 15-16, and at the time of giving this gift, the market value of the property is $100,000. The market value of that property is $100,000, right? Let us say I died after 2 years, so within 7 years I died. So this pat will be chargeable. But at the time of death, the market value of this property rose to 300,000. At the time of gift, the market value was 100,000, but after 2 years, that means that in the year of death, it rose to 300,000. So now the question is, sir, do we have to pay tax on 100,000 or 300,000? Just 100,000. Increase in values is must be ignored, and that's one of the benefit of PAT. That's one of the benefit of PAT, and that's one of the planning point. Listen, for example, I'm a daddy and I have three assets. And I have to give only one asset. I have to gift only one asset. So I must choose that asset whose market value is about to increase very high. So in that case, I'll transfer that asset and I'll lock the market value whose market value going to increase in future, right? Okay, right? Now, my dear students, second lifetime gift is chargeable lifetime transfer. What's the identification of this chargeable lifetime transfer? Sir, what's the shortcut of this? CLT. We call it CLT. Okay, CLT. And how do we recognize CLT? It's just one line: give to trust, give to trust, give to trust. Whenever you give to a trust, that's called CLT, chargeable lifetime transfer. Okay, now the name itself says chargeable. That means whenever you do CLT, you have to pay first installment. You have to pay first installment in the year of gift. Now you are alive, donor is alive, and the the first installment of CLT is to be paid in the year of gift, and that first installment is called lifetime IHT on CLT. Lifetime IHT on CLT. Don't worry, I'll teach you how to calculate it. I will teach you. Don't worry. Now, one more thing, the same thing. If donor died, within 7 years from the date of gift, within 7 years from the date of gift, then additional IHT on CLT will also be payable in the year of death. Okay, so in short, there are maximum two types of taxes on CLT. The first is lifetime IHT. Lifetime IHT is payable in the year of gift, in the year in which you do gift, right? And this additional IHT is only payable. This additional IHT is only payable if the donor died within 7 years from the date of gift. What if, sir, if donor died after 7 years, then there is no additional IHT, then there is no additional IHT, right? Then only one tax, that is lifetime IHT. Now, same concept, same market value of gift is locked at the date of gift. The same concept, just we discussed in PAT. Market value, which market value will be considered? Market value will be considered the one at the date of gift. Okay, increase in market value will be ignored again. Increase in market value will be ignored again, right? Okay, Now open your eyes, open your eyes, be very active, be very active. You are in revision days, you are not on normal classes, please. Now for lifetime IHT, lifetime IHT on CLT, lifetime IHT on CLT means the first installment which we pay in the year of gift. There are two options. Either trustees can also pay this first installment. If trustee pays this first installment, then the tax rate to be used is 20%. Open your eyes. Then the tax rate is to be used is 20%, and no need of grossing up, okay. If lifetime IHT is paid by trustees, then you have to use 20% rate for the calculation of lifetime IHT, and no crossing up is required. But there is one more option. My dear. Donor can also pay this first installment, what we call it lifetime IHT. In that case the tax rate for the lifetime IHT is 25%. Look at here, the tax rate to be used for lifetime IHT is 25%. And you have to do one more thing, be very careful, then that is crossing up. Sir, what is grossing up? What you do? First, you write the CLT, the amount of gift after annual exemption. First, you write the CLT after annual exemption. And then you add the lifetime IHT which you just calculated. Then you add the lifetime IHT which you just calculated, and you add both of them, and this we call it gross chargeable transfer. Sir, can you tell me the logic of this crossing up? Look at me very carefully. My camera is on. Look at me. You know the rule. IHT is always calculated on decrease in wealth of donor. Now listen, this time the donor is paying tax. See, look at me. So let us say the donor is gifting this pen. So this pen is going out of the pocket, and then again the donor puts the hand in the pocket and he took out the cash, the tax, and he also paid the tax. So now listen, the total decrease in wealth is this pen. Plus the lifetime IHT. So when we add both of them, then we will come to the actual decrease in wealth of donor. So the logic of crossing up is one line. What? IHT is computed on decrease in wealth of donor. Giving you 20-30 seconds. Just look at this sketch. Come on, boys. Now, one more good news. Listen, there is one concept which we call it taper relief. Listen, first of all, there is no taper relief on death state. One line, no taper relief on death state. I have not written here, but I can orally telling you this. There is no taper relief on death state. Taper relief is only calculated only for PAT and additional IHT on CLT. Taper relief is only calculated on PAT and additional IHT on CLT. Now, listen, what were the rules? Let us say donor gift an asset now, and he died after 7 years. Then no 0% tax, no tax. Donor did PAT now, and he died after 7 years. After 7 years of PAT, then 0% tax. But you know, tax department has given one more favor. If you die before 7 years, or if you die, I should say, if you die close to 7 years, then you will get a new relief which is called taper relief. Look at the screen. If you die after 7 years, then 0% tax, then 100% exemption or 0% tax. 100% tax is exempt, or you can say 0%. But if you die after 6 years, and before 7 years, if you die after 6 and before 7, you will get 80% waiver. You will get 80% exemption of tax, that is taper relief. And if you die after 5 and before 6, then 60%. after 4 and before 5, 40%, after 3 and before 4 it's 20%, and if you die before 3 years then you died very early, then you are not eligible for any taper relief, then you are not eligible for any taper relief. Okay, now i'm I'm using some historical words, very famous lines. If you want to write, you may write. For taper relief, look at me. For taper relief, always count the gap between date of gift and date of death, date of gift and date of death, date of gift and date of death. Whenever you need to calculate taper relief, you need to count the gap between date of gift and date of death. Okay, now one more good news, one more exemption. This is called annual exemption. I hope you studied annual exemption of CGT yesterday. That was £12,000. For IHT, annual exemption is £3,000 per annum. Per annum means per fiscal year, right? First of all, keep in your mind that annual exemption is not available for death state calculation. Annual exemption is not available for death state calculation. Forget it, please. Annual exemption is only available for lifetime gifts like PAT and CLT. Lifetime gifts like PAT and CLT. Okay. Now the first rule, it's 3,000 per annum, right? The first rule, for example, there is a fiscal year. For example, there is a fiscal year and there are two gifts. There are two gifts in that fiscal year. One is PAT and other is CLT. First you did PAT and the other one is CLT. Now, sir, how are we gonna use this annual exemption for this fiscal year? The strict rules, the rules are very strict. Sorry, it's tax you have to follow. The rule is always use left to right, always use left to right, left to right. So left to right, the PAT is coming first. So first of all, we'll use annual exemption for PAT. Okay, don't forget. Then one more good news. For example, and we are in 15-16 fiscal year. In 15-16 fiscal year we didn't give any gift, so our annual exemption is unused. So the good news is unused annual exemption can be carried forward for only 1 year. That means 15-16 annual exemption can be used for 16-17, right? Only 1 year, and then it will be expired. Now the next thing, for example, there is a fiscal year in which we are in 16-17 now. In 16-17 we have one annual exemption of 16-17 3,000 and one annual exemption of previous year, one annual exemption of 16-17 and one brought forward of last year. Now which annual exemption to be used first? Look at here. Always use current year annual exemption first and then last year. Always use current year annual exemption first and then last year. Don't forget this. These are very small little things, and these carry almost 2 marks, because this topic normally comes in OT cases, and in OT cases if you do a slight mistake, the whole MCQ is wrong. Now there are some more exemptions. This is what we call marriage exemption. Obviously UK government also studies this, that not all wealth transfer is taxable for IHT, because there are some events like marriage. All parents normally give with their own wish, to their son, daughters, right? That's the time of happiness, right? So that law is relaxed here. Marriage exemption. What is marriage exemption? First £5,000 by parents, excess is PAT. At the time of marriage, if parent, mom or dad, if they give separately 5,000 gifts, this 5,000 is exempt. This 5,000, first 5,000 is exempt. The excess is PAT. What does it mean? Wait. For example, mom gifted £7,000. To daughter. That means out of this £7,000, first 5,000 will be exempt through marriage exemption, and the excess 2,000 will be treated as PAT. Now for grandparents, for grandparents, first 2,500 by grandparents is exempt. Just like parents 5,000, for grandparents is 2,500, And what about the other guests? Other guests are first 1,000 pounds. First 1,000 pounds. Okay, one more thing. Don't forget that for marriage exemption, in 3 lines, I've used the word first, first, first. That means excess will be paid. That means excess will be paid. Don't forget. And listen, if you read the examiner report of last September 2020, these things come, this marriage exemption came in the exam. Okay, now one more topic, small gift exemption. Small gift exemption. If in any fiscal year, this small gift exemption is not related to marriage exemption. Okay, this is a separate topic. In any fiscal year, if you look at me, in any fiscal year, if you do gift to anybody less than 250, in one fiscal year you give gift to your daughter of 200 pounds, it's totally exempt. 220 pounds, it's totally exempt. But if the total gifts, if the total gifts in one fiscal year to any party, if the total gifts to in one fiscal year to any party exceeds 250, then whole amount is paid, not just the excess. For what is the example? For example, you gifted 320 pounds to your daughter. In this fiscal year you gifted 320 pounds to your daughter. So 320 pounds is greater than 250. Now the complete 320 will be treated as paid. Don't forget. Okay, so in marriage exemption I use the word excess, but in small gift exemption I use the word complete amount. Complete amount will be taxable. Right, now there is one more thing. Look at here, look at here. This is what we call small, this is what we call a small gift exemption. Listen, listen. In the very first slide I use the word IHT is not income tax. IHT is a wealth tax. So IHT is not meant to stop your daily life. Just think, on routine daily, parents pay the fees of school fees, parent gives pocket money to kids, routine for routine daily life. So if IHT is applicable on each and every transaction, then people will leave. Literally, people will leave UK. Nobody will stay in UK. Okay, so the law is relaxed here. If you are giving gift out of income, they are habitual in nature and does not affect the donor's standard of living. Does not, like every month you are paying 200, 500 pounds pocket money to your daughter, to your son. You are paying the school fees, and it's habitual routine, and it's from your income, routine income. Then there is no IHT. Even this thing is not bad. Even this thing is not bad. Okay, okay. Now, so you must have knowledge of these things. Now we are starting a practical area. Be very careful, be very active. Okay, at the time of death, listen, at the time of all death taxes have one single rate, 40%. In IHT, all death taxes have only one single rate, that is 40%. Okay, what are the taxes names? The question is, sir, name the taxes which are computed at the time of death. Name the taxes which are computed at the time of death. You can count. One is pat within last if pat is done within last 7 years of death, then this pat is chargeable at the time of death. Number two, if any CLT is done within last 7 years of death, then you have to calculate additional IHT on CLT at the time of death. And the third and the last thing and the most important, yes, IHT on death state. IHT on death state. IHT on death state, right? So these three are the death taxes: PAT, additional IHT on CLT, and IHT on death state, right? Okay, now I'm going to solve a practical question in front of you, because there are a lot of practical things in IHT. Now let us say there is a guy who did only these two gifts, no other gifts in the whole life, and he died on February 2020. See, this is the date of death, February 20. I've just written the month of death. Okay, now first of all, 1st July 2015, he was alive, he was taking breath, he was alive. 1st August 18, alive. He died on February 2020. So the first gift he did is CLT on 1st July 2015, and this CLT was 406,000. 406,000. Okay. Now, hope you remember the annual exemption. Just think, I just said he just gifted these two gifts, no other gifts in his whole life. So 1st July 15, first July 15 lies in 15-16 fiscal year, and before 15-16 there is a fiscal year 14-15. Open your eyes and you can see there is no other gift in 14-15. So obviously you have unused annual exemption of last year. So last year annual exemption can be used this year. So 3,000 of last year and 3,000 of this year. This makes 6,000. See, this makes 6,000. Okay, so 406,000 less 6,000 will make, don't please forgive my bad writing, because my writing is good, but right now I'm writing with the broken hand, that's why it's not that much good. Okay, now for PAT 1st August 18, for 1st August 18 is 206,000 PAT. Wait, 1st August 18 lies in 18-19 fiscal year. 1st of August 18 lies in 18-19 fiscal year. Now just think, boys and girls, please look at me. 18 before 18-19, the last fiscal year is 17-18, and you can see there is no gift in 17-18. So 17-18 annual exemption in unused. So definitely you will have 6,000 annual exemption, and when you deduct 6,000 from 206,000, you will have 200, you will have 200,000, right? Okay, so finally we just deducted annual exemption. So there are only two gifts, and I've just subtracted annual exemption. I'm just keep quiet because I was on 30 seconds. Okay, 30 seconds. You can see. Because of Azan, I'm quiet. All right. Okay, just 30 seconds. Now, come on. Time is very important. Now let's start calculating the tax. First of all, in his life, first July 15 comes first, and in July 15 there is a CLT. So we all know for CLT we have to pay the first installment, which we call lifetime IHT. Now, as this question is prepared by me, so I'm orally telling you. Listen, we are assuming that the first installment is paid by trustees. First installment is paid by trustees. Okay. Now look at it, look at here. First installment is paid by trustee, so we have to use the tax rate of 20%. We have to use a tax rate of 20%. Okay, let's start. And don't forget, the person is alive. The person is not dead. Now look at here, look at here, look at here. The heading is lifetime IHT on CLT. Lifetime IHT on CLT. Now what is the chargeable amount of CLT? This is 4 lakh after annual exemption. Okay. Now if you remember, if you guys remember, this, the person is alive right now, and this gift is given in 15-16 fiscal year. So what we do, we have to use the NRB, nil rate band of 15-16. In the question, I just moved the slides. In the question, it is, it's 1 minute. Hello. मैंने अभी क्वेश्चन साइलेंट किए हैं. Wait. व्हाट्सएप ग्रुप का है कोई? हाँ ठीक है, अब जरा मैं wait now. Look at here, look at here. So lifetime IHT on CLT means the person is alive right now, and we are going to calculate the first installment. So we have to use NRB of that fiscal year, and it is ready made given in the question. I just moved the slide. It was 325,000. You will always be given, right? Now the second news, be open your eyes please, important discussion. Second news is that NRB is always cumulative for 7 years. It's total combined, it is combined for 7 years, right? So for NRB, you always have to see, you always look at the screen. You will always, for NRB, you will come to the date of gift. You will stay at the date of gift, and you will see last 7 years. Look at my screen. You will stay on the date of gift, and you will see back last 7 years, and you will see, did you calculate any IHT? Did you calculate any IHT on any gift? If yes, then you have to reduce. Then you have to reduce your NRB. You have to reduce your NRB from that amount of gift. If you have calculated tax on any gift in last 7 years, definitely that should be CLT then, right? But in this question, see, in last 7 years there is no gift. In last 7 years there is no gift, so your NRB is totally unused. Your 325,000 NRB is totally unused, so you are relaxed. So you can use complete NRB here. Look at here, look at here. Reduction 325,000 less reduction is 0. Less reduction is 0 because no gift in last 7 years. So complete 325,000 will be used. So 400,000 less 325,000. First 325,000 there is no tax. Excess is 75,000. Now tell me what is the tax rate? What is the tax rate? What is the tax rate? The tax rate is 20%. Why the tax rate is 20%? Because I just told you, in this case the lifetime IHT is paid by trustees. The lifetime IHT is paid by trustees. So you will have 15,000. This is the first answer. You have calculated the lifetime IHT on CLT. So you have just calculated the lifetime IHT on CLT. Okay, now done. Now, wait. Again, come to the question. This lifetime IHT is done. This is done. Okay. Now the person is still alive. Don't forget, the person is still alive. He's breathing in out. Now, after some time, he did PAT. Now, boys and girls, just think: if a person is alive and he just did PAT, there is no tax. There is no tax or on PAT in the year of gift. There is no tax on PAT in the year of gift. So you just give them a smile. No tax computation. Leave it. Now, finally, the end day. This is death day. This is death day. The person died on February 20, right? Okay. Now wait, now we have to start death taxes. Now what's the first and the most important step of death taxes is, from the date of death you have to go 7 years back. From the date of death you have to go 7 year back, and you have to mark that date. So from February 2020, if you go 7 years back, so you will come to February 2013, right? You go 7 years back and you will come to February 2013. Now look at my face, my camera, my fingers. And from last 7 years, now you have to walk. You know how to walk? You have to walk left to right. See, left to right, left to right, left to right. Which gift is coming first? CLT. Which gift? Left to right is must, left to right is mandatory. Don't forget. You go 7 years back from the date of death, and then you start walking left to right. So if you walk left to right, the first thing will come, that is CLT. The first thing will come, that is CLT. And if I'm not wrong, and if you are seeing this question, you can easily see that the person died within 7 years of this CLT. The person died within 7 years of the CLT. So now you have to calculate. Now you have to calculate. Now you have to calculate additional IHT on this CLT. Additional IHT on this CLT. Okay. Now how do we calculate it? In the death, you know for death taxes you get again NRB. You get again NRB of 325,000. And for 1920 fiscal year, the NRB is again 325,000. For 1920 fiscal year, there is a fixed NRB you have to learn, that is 3,325,000, right? And now we have to do working from zero. Okay, so these are the death taxes. See, these are the death taxes, and I have used the black pen. I've used the black pen. Okay, for death taxes I'm using black color pen. Now what's the heading? Additional IHT on CLT. Additional IHT on CLT. What's the amount of CLT? What's the amount of CLT? The amount of CLT is 4 lakh. Now again, you have NRB of 3,25,000. You have NRB of 3,25,000 at the time of death. Now I just told you NRB is always for 7 years. NRB is always for 7 years, and you have to look back 7 years. Now, very important, the biggest mistake students did. Listen, for 7 years, you don't have to stay at the date of death. You have to stand at the date of gift. You have to stand at the date of gift, and you look back 7 years. So just think, from the date of gift, what's the date of gift? The date of gift is 1st July 15. See, the date of gift is 1st July 15. If you see last 7 years, there is no gift. If you see last 7 years back from 1st July 15, there is no gift. So that means your total NRB is unused. Again, your total NRB is unused, and you can easily use it. You can easily use it. Now let's do it. So there is no reduction. You will be using complete NRB. You will be using complete NRB of 325,000. So 4 lakh less 325,000 will give you 75,000. Now boys and girls, tell me, these are death taxes. For death taxes, there is only one tax rate. For death taxes, there is only one tax rate, and that is 40%. For death taxes, there is only one tax rate, and that is 40%. Tell me, 75,000 times 40% is how much? 75,000 times 40% is how much? This is, I think, 30,000. Okay, 30,000. Okay. Now one more thing. I hope you remember the taper leaf. I just taught you the taper leaf. For taper leaf, listen my dialogue. For taper leaf, always count the gap between date of gift and date of death. For taper leaf, always count the gap between date of gift and date of death. Now, look at me. I don't want to move the screen. Now, listen. Date of gift was 1st July 15, and date of death was February 2020. Let's count. From 1st July 15 to July 16, 1 year. July 17, July 18, July 19, and no more July 20. No more July 20. Repeat. From 1st July 15 to 16, 1 year. 17, 18, and 19. There is no more July 20, because the person died in February 20. So it's more than 4 years and less than 5 years. Is more than 4 years and less than 5 years. So taper relief will be 40%. Between 4 to 5, taper relief is 40%. Okay. Let's deduct taper relief, TR, at the rate 40%. 30,000 less 40%. What's the 40% of 30,000? It's, I think, 12,000. So let's write 12,000 here, and 30 minus 12. 30 minus 12 will give you 18. 30 minus 12 will give you 18. Now, wait. 30 minus 12, we are very close to success, please. 30 minus 12 is 18. 30 minus 12 is 18. Now this is the total IHT. This is the total IHT on CLT, but don't forget what we have to calculate. We have to calculate additional IHT. We have to calculate additional IHT. So just think, we have already paid. We have already paid some IHT on CLT. We have already paid some IHT on CLT, and now we have to calculate the additional. So just simply deduct it. Simply deduct the IHT already paid. Simply deduct IHT already paid. This is, I think, 15,000. So the number is, the final amount is 3,000. Okay. So this is your additional IHT on CLT. The first death tax is here. The first death tax is ready. The first death tax is ready. The question is not done yet. The question is not done yet. Now, I told you about the left to right walk, left to right walk, left to right walk. See, from the date of death, you went 7 years back, and then left to right, left to right. First this CLT, you just did it. You just did everything for the CLT. Now, more walk, left to right, left to right, left to right. Now again pat. Now this pat of 2 lakh, and now just think, the donor died within 7 years. Within 7 years of this pat, the donor died within 7 years of this pat. So yes, this pat is also chargeable at the time of death. This pat is also chargeable at the time of death. Okay, so let's calculate the IHT on pat. IHT on pat. See this. What's the amount of this pat? 2 lakh. The amount of this pat is 2 lakh. Now again, you are doing death taxes. For death taxes, you have 3,25,000 NRB. For death taxes, you have 3,25,000 NRB. But don't forget the 7-year accumulation principle. Now you will see the real application. Now, for NRB reduction, we never stay at the date of death. We stay at the date of gift. We stay at the date of gift. And what was the date of this gift? I think 1st August 18. 1st August 18. The date of this gift was 1st August 18. You will stay at 1st August 18, and you will see 7 years back. See, you stay at the date of gift and you see 7 years back. Yes, 7 years back there is a big giant CLT. There is a big giant CLT for which you just did calculation. There is a big giant CLT for which you just did calculation. Yes, so that CLT definitely consume the NRB. So what is the law? I'm using the wordings of law. In last 7 years, you have to see, did you calculate tax on any gift? Yes, we did. So just deduct the value of that gift. Just deduct the value of that gift. That was 4 lakh. Just deduct the value of that gift after annual exemption. It was 4 lakh. So obviously, if you deduct 325,000, if you deduct 4 lakh from 325,000, nothing will be left. Nothing will. So it's zero. It's nothing. So complete 200,000 is your chargeable amount. Okay. And my dear students, what's the rate of death tax? What's the rate of death tax? It's simply 40%. So 200,000 less 40% gives you 80,000. Gives you 80,000. 80,000. 200,000 times 40% gives you 80,000. Now, sir, you forgot one thing. Oh, what? You forgot taper relief. My dear student, okay, let's try taper relief, but don't forget the wordings. For taper relief, always count the gap between date of gift and date of death. For taper relief, always count the gap between date of gift and date of death. So date of gift was 1st August 18. August 18 to August 19, not even August 20. So he died before 3 years. Before 3 years, so there is no taper leave. So this is your full and final tax. This is your IHT on PAT is full and final tax. Okay. Okay. Let me show you the slides just for 30 seconds. The two slides. Wait. These are the two slides, or I should say the complete solution. Okay. Now, one cash marks. I must say this is ready marks. Computation of death state. Computation of death state. It came many times. I've seen this many times. What is death state? Let us say a person just died. Whatever wealth he has at the time of death, this is what death state is. Okay. So what we do, you just add all assets. You just add all assets, even all assets include individual savings account, guilds. What there are some assets which are exempt for CGD, but they are not exempt for IHT. All assets, just add all assets. Okay. less liabilities Less liabilities for which consideration was taken by deceased. Now, only those liabilities are allowed. Only those liabilities are allowed for which the deceased got benefit in his life. For example, deceased just before the death, 1 week before the death or 2 week before the death, the deceased went for shopping, and he used the credit card. So definitely, when you use credit card, you buy some things, right? So he got the consideration. So these debts are allowed. But don't forget that gambling debts or verbal promises, that for example, disease promise to a poor guy that I will help you in your school fees or something. So such verbal promises are not allowed. Okay. Less mortgages. Yes, mortgages allowed. Normal mortgages are allowed, because normally in UK, USA, 99%, 90% houses are on mortgage, right? That's the culture. So normal mortgage is allowed, but one mortgage is not allowed. And that is endowment mortgages. Listen, what is endowment mortgage? Endowment mortgage means you have taken a loan, but you are not responsible to pay that loan. The insurance company will pay that loan. So you are not responsible. That's why that endowment mortgage will not be deducted from your death state calculation. Okay. One more thing which I have not written here, but you all know. And let me tell you, I've written all assets. All assets means their market values. But there is one asset which is called life insurance proceeds. There is one asset which we call it life insurance proceed. So never include the market value of life insurance or life assurance policy. Just add the actual receipts. Of life insurance or life assurance policies. Okay. And finally, you can less the funeral expenses. Okay. So here you will have the chargeable state. This will be your chargeable state. This will be your chargeable death state. Okay. Right. So sometimes this death state working is given ready-made. Death state number is given ready-made, and sometimes you have to calculate it. But whenever it comes, it's easy marks. Now this is a spouse exemption, very famous, between husband, wife, and civil partners. Husband, For example, husband gives wife £1 million, $1 million in life or even after death through will. No tax, no tax. Just you have to line spouse exemption and that's it. So no more chargeable events between husband, wife, and civil partners in life and also after death. Okay, any gifts, any gift. Just write one word spouse exemption. Just write one word spouse exemption. Now this is a technical topic. This is a new topic. This is a new topic. Please. I will try my best, but you also have to give energy. This is a new topic which is called residence NRB. This is called residence NRB. First of all, see, this is an extra NRB other than normal NRB. I hope you remember the 325,000 NRB. I hope you remember the 3,25,000 NRB. So this is extra NRB. This is a new NRB other than that NRB. That is separate. And one more thing, that normal NRB we apply 7 year accumulation principle. For that normal NRB we apply 7-year accumulation principle. Now, one first thing, I've written almost all points here. Only available for the computation of death state IHT computation. Listen, this residence NRB is not available. This residence NRB is not available for PAT and CLT. Forget it. This residence NRB is not available for PAT and CLT calculation. This is only available for the calculation of death state. Death state. Keep it in your mind. Very important points. These are easy marks. Number two, what is the amount of residence NRB? Is 1,50,000 per one person, 1,50,000. The amount of residence NRB is 1,50,000. Okay, right? Now, what are the conditions? What are the conditions which must be met in order to qualify for residence NRB? These are the conditions. See, number one, individual died on or after 6th April 2017. First thing, if you want to include residence NRB in the calculation, read the date of death. Read the date of death. The person must be died on or after 6th April 2017. This is the first condition. Number two, main residence inherited by direct descendant. Listen, in your will you have written that, listen, look at me and look at this sketch, this highlighted thing, that you have to give your property downward in your generation. For example, father is giving to son, father is giving to daughter. For example, father or grandfather giving to grandson, like this. It should not go like this. For example, if in the will it is written, that you have given the main residence, to your brother, you are disqualified. You are totally disqualified from this relief. Okay, so this thing is must see this. You see this highlighted thing, grandfather to father to son, like this. It should go like this. Value of total debt state must be greater than 3,25,000. This is one more condition. And if you want to use this residence NRB, your total debt state must be greater than 3,25,000. One more thing, your debt state we just studied must include main residence. Your main residence must be part of the debt state. And finally, and one extra point, even this extra point is not written in the article, but this is a mistake people do. There is no 7-year accumulation principle for this NRB. 7-year accumulation principle is only applicable for normal NRB, not for this NRB, my dear students. Okay, now we are going to start the first question. But before we move to this first question, I want to take a 5 minutes break. I want to take a just a 5-minute break. Okay, right? So what you should do, the screen sharing is on. You can just read this question. If you want to take the break 5 minutes, you can. See you after 5 minutes. See you after 5. Okay, welcome back. Now we are starting this question. Not that much difficult. Just focus. Focus is very important. Don't use your cell phone. Just focus on the screen, please. Let's start. Tom died. Very important date. 1st May 2019. Don't forget this date. This is the date of death. 1st May 2019. Okay. Now they are telling you the story history. He had made a gift with a chargeable amount of 4,50,000 for after all available exemptions. Thank God, that means annual exemption has already been deducted. Okay, to a trust, to a trust, to a trust. That means it's CLT. It's CLT. Okay. Now we all know for CLT. Look at me, but dear, for we all know for CLT you have to pay lifetime IHT the first installment, right? And for first installment, two options: either donor can pay or that trustee can pay. So Tom paid Tom paid the inheritance tax arising on the gift. That means donor is paying. Donor is paying. So you tell me what should be the rate? What should be the rate of lifetime IHT? Definitely 25%. I already told you. I already told you 3-4 times. Okay. So for this gift, 25% should be used. 25% should be used. Now wait. I'm not going to read the complete question. I'm going to solve the first part. The first part. Now you can see in the screen there is he had made a gift, only one gift. And also this was Tom's only gift. That means in his whole life this person did only one thing. This is the only gift. That means last 7 years from February 13, if you see last 7 years, it's so totally free. Last 7 years are also totally free, right? And one more thing, February 13, February 13 lies in 12-13 fiscal year. See, February 13 lies in 12-13 fiscal year. So I just told you, even I solved a question with you guys, practical question with you guys, that for lifetime IHT on CLT, you have to use NRB of the same fiscal year, of this, not the fiscal year of death, the same fiscal year in which you have given the gift, and this is 12-13. This is 12-13. This is 12-13. Okay. Okay, let's start the first part. See. See the screen. What was the gross chargeable amount? What was the gross chargeable amount? In my slides, I just taught you. In my slides, I taught you this, the gross chargeable amount. Okay. Gross chargeable amount means, let's look at here. The amount of gift, the amount of gift, the amount of gift plus that lifetime IHT on CLT. The amount of gift plus that lifetime IHT on CLT, sum of these two. Okay. So the amount of gift is already in front of you, that is 450,000. The amount of gift is already in front of you, that is 450,000. But yes, you have to calculate lifetime IHT on CLT. Let's do it. Come on, look at here. CLT is 450,000. And what was the NRB which we just read? 325,000. 325,000 NRB is available for 12-13. And now 7-year accumulation principle. NRB is available for last 7 years. Okay. So you stay at 1st February 13 and you look back 7 years. You look back 7 years. You look back 7 years. So there is no gift in last 7 years. So this NRB is free. If this NRB is unused, so what you do, you will use complete three. You will use wait. You will use complete 325,000 here. So 450 minus 325,000 is, I think, 125,000. Okay, I think it's 125,000. And now what's the tax rate on this excess amount? As donor is paying the first installment, so 25%. So 125,000. Wait, let me calculate. 125,000 times 25%. 125,000 times 25% is 31250. Is 31250. Okay, now what you have to do, this is lifetime IHT on CLT. Just simply add it in 450,000. You will get gross. So how you will get gross? 450. Look at me, 450 plus this 31250. So it become 481250. This is the answer. 481250 is the answer. 481250 is the answer. 481250 is the answer, right? Okay. So that's the answer of your first question. The answer of one is C. Answer of one is C. Now, the second question is little bit dodgy, or I must say, there is a weakness in students. They can't recognize fiscal year. Many students, and even in my classes, I always focus. I give them dates. I tell them, okay, 1st January 2009, tell me the fiscal year in which it lies. Then I say December 2018, tell me the fiscal year. February 2018, tell me the fiscal year. This is very important, and you also should practice this. That by looking at any date, you can easily identify the fiscal year. Okay, that's very important. Now, question number 2 is also connected to this part. If Tom had made cash gifts of 5,500 to his daughter, yes, one person giving gift to another person is PAT. One person giving gift to another person is PAT. Okay, and there is no marriage here. So no marriage exemption. This is full-time PAT. This gift to daughter is full-time PAT. And 400 to his granddaughter. 400 to his granddaughter. This is also PAT. So student may ask, sir, you just taught us small gift exemption. No, dear, this 400 is greater than 250. This 400 is greater than 250. And in a small gift exemption, when you cross 250, the complete amount is PAT, not just excess. Complete amount is PAT, not just excess. So this 5500 and 400 both are PAT. This 5500 and 400 both are PAT. If you add these two, your total PET, your total PAT on date 20th December 11, 20th December 11 is 5900. Now you, all of you, I will tell you, don't worry, just recognize that 20th December 011, 20th December 2011 lies in which fiscal year? 20th December 2011 lies in which fiscal year? So your answer will be, sir, 11-12. It lies in 11-11-12 fiscal year. Okay. What would have been the amount of annual exemption available on the gift into trust on 20th February 13? Now you tell me. 20th February 13 lies in 12-13. 20th February 13 lies in 12-13 fiscal year. Okay. Okay, so now let me explain you. Look at here. Let me enlarge you. Listen. In his life, please, he just did these gifts, no other gifts. So in 11-12, he did PAT of 5900. Tell me the last fiscal year before 11-12. It's 10-11. Last fiscal year before 11-12 is 10-11, and you can see there is no gift in 10-11. There is no gift in 10-11. So in 11-12, you have two annual exemptions. You have two annual exemptions, 3000 for 11-12. In 11-12, you have two annual exemptions available, 3000 for 11-12 and 3000 of previous year. But wait, how to use annual exemption? I told you. You remember? Always use current year first. So you will use 11-12 first, 11-12 annual exemption first, okay, and then last year annual exemption. So how much annual exemption you need from last year? Only 2900. How much annual exemption you need from last year? That is only 2900. Now the student will ask one question, sir, what about this 100 annual exemption is still left? That will be expired. That will be wasted. Why? Because 10-11 annual exemption can only be used till 11-12. 10-11 annual exemption can only be used till 11-12. Okay, so that 100 is wasted. Now listen the question. You are here in 1213, you are giving a CLT. In 1213 you are going to give a CLT for, and 1213 just think, in 1213 if you see the last year, you have already used the last year annual exemption. You have already used the 1112 annual exemption in PAT. So in 1213 you have only 3000 annual exemption is left for 1213 own. That's it. My dear student, for 1213 CLT, you have only 3000 annual exemption of that fiscal year. Don't think that you have the brought forward annual exemption, because that has already been used. That has already been used in PAT. Okay, so your answer is 3000. Examiner, what examiner asked, that how much annual exemption is available for CLT which we did on 20th Feb 13, that is only 3000. That is only 3000. Okay, because the last year's annual exemption already been used. Now question number 3. Question number 3. In respect of the gift, again the question number 3 relates, to the same starting point which we read, same starting paragraph. In respect of the gift to the trust on 20th Feb 13, what rate of taper relief applied to IHT payable on Tom's death, and who is liable to pay this additional IHT arising on death? Select the appropriate box. Okay. Wait. First, let me discuss you the taper relief. See, my sketches are ready. I told you this. For taper relief, always count the gap between date of gift and date of death. For taper relief, always count the gap between date of gift and date of death. Go easy, go relax. The date of gift is 20th Feb 13 and date of death is 1st May 19. Date of gift is 20th Feb 13 and date of death is 1st May 2019. Okay, right? Listen, let me count with you. From Feb 13 to Feb 14, Feb 15, Feb 16, Feb 17, Feb 18, Feb 19, but there is no Feb 20. He died before Feb 20. That means more than 6 and less than 7 years. That means more than 6 and less than 7 years. So definitely taper relief is 80%. Taper relief is 80%. Okay. And I hope you remember these rules of payments. What, who is responsible? Who is responsible to pay additional IHT on CLT? That are trustees. Trustees normally pays. Trustee pays. So your answer is, wait, taper relief rate is 80% and trustees. This is the right matrix. See 80% and trustees column. The row is 80% and the column is trustees. Okay, so who is responsible? For paying additional IHT on CLT? The trustees. Okay, so for question number 3, your answer is C. Okay, all of you, just write down the feedback. Are you getting these 3 questions? We just did these 3 questions. Are you getting write down in the question in the chat box, all of you, come on, stay connected. Did you understand the last 3 questions? Now we are moving to the question part again. Tom's estate. Tom state means death state. Tom state means death state. Now we are going to calculate death state. Just I taught you. Tom's state at the date of death included the following assets as well as some cash in the bank. Okay, a 50% share valued at 150,000 in success race horse. Now listen, 50% share, this is the value of exact 50%. Okay, so this value will directly go in the death state calculation, 150,000. And as I told you, at the time of death, whatever you own is part of your death state. All assets are included in your death states. Okay, so this 150,000 will be included as it is. Then cash winnings from betting on horse racing, 40,000. Yes, this definitely, this is your asset, you will include. Now number three, it should click in your mind. His main residence valued at 875,000, which has an outstanding repayment mortgage. That means normal mortgage. Normal repayment mortgage means normal mortgage. Please, it's not endowment mortgage. It's normal mortgage, and yes, normal mortgage is always allowed. So how do we calculate this final part? 875,000 less 500,000. 875,000 less 500,000. This is going to be 375,000, right? So these three numbers will be added in the death state. These three numbers will be added in death state. Which number? 150,000, 40,000, and 875 minus 500,000, that is 375,000. Now just for your knowledge, by looking at the main residence, something clicked in my mind, the residence NRB. Residence NRB, maybe examiner may ask residence NRB because his death state includes the residence NRB. Okay, now let's do the MCQ number 4, the second last MCQ. Easy one. What is the net value of the state assets 1 to 3? Point number 1 to 3, that will be included in Tom's chargeable death state. I hope you remember the number. 50% share in race horse, that is 1,50,000. Okay, cash winnings 40,000. And now tell me the main residence. There was some mortgage as well. So 875 minus 8, this number 375. 875 less 500,000 makes 375,000. 375,000. Okay, done. Now the last part, the last and the most important part. I think they might ask residence NRB from us. Let me read the last final lines. Okay. The executors have determined that Tom's chargeable state for IHT purposes was 2 million. See, the ready-made death state has given. So the student may ask, sir, what was the above points? These were the part of death state. Now they are giving you the complete total death state. The executors have determined that Tom's chargeable state for IHT purposes was 2 million. Okay, now you have to calculate death taxes. They filed their account of the state with HM Revenue and Customs on 3rd January 2020. No issue. Now, Tom left, please open your eyes. Tom left all of his estate to his children, downward, going downward in the generation, Now tell me, all residence NRB condition looks like we have met all conditions. Looks like we have met all conditions. Please open your eyes. This guy died on 1st May 2019, that is after 6th April 17. First condition. Number 2, the death state includes the main residence. See, the death state includes the main residence. Second condition. Number 3, he is giving main residence to in the generation downward. Yes, and his total chargeable estate is greater than 3,25,000. His total chargeable debt state is greater than 3,25,000. So that means all conditions have been met for residence NRB. All conditions have been met for residence NRB. Okay, so my dear, I'm going to calculate, I'm going to use residence NRB in death state calculation, that is 150,000. Now As an active student, you may ask one question, sir, when we studied IHT, you all have studied IHT in your life, obviously you are TX F6 students. Sir, we studied one topic, the transfer of NRB from spouse. The transfer of NRB from spouse. Hope you remember this. Sir, do we apply this topic here? No, 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 no. Why? Because his wife is still alive. That topic is only applicable if his wife has already passed away. Then we and if there are some unused NRB in past, if there are some unused NRB in past, then he can use. But this topic is not applicable here because it's clearly written that his wife is still alive. His wife is still alive, so only his own NRB we can use. Only his own NRB we can use. Okay. So now make your mind. I am going to calculate IHT on death state only. IHT on death state, not on CLT, only on death state. Okay, let's do it. Okay, look at here. For death state calculation, this is the date of death. This is the date of death, that is 1st May 2019. I taught you my own question first, and in that question I taught you that you have to go 7 years back. For death state calculation, you have to mark one spot 7 years back. So 1st May 2019, if you go 7 years back, there will be 1st May 12, 1st May 12. Okay, last 7 years. Can you see the last 7 years from the death? Now you can see there is a CLT in between. You can see there is a CLT in between, and this is a common sense thing that this CLT must have used your normal NRB. This CLT must have used your normal NRB. So don't expect any normal NRB of 3,25,000 in the death state calculation, because already been used by CLT. Okay, but right now examiner is asking to calculate the tax on death state only. Examiner is asking to calculate the tax on death state only. Okay, what I have written here, IHT on state, IHT on state. What is the value of state? 2 million, ready made from the question. The value of state is 2 million. Just copy paste from the question. Now, was there any residence NRB available? Yes, I taught you all the conditions of residence NRB have been met. So just simply deduct 150,000, and there is no 7-year accumulation principle for this residence NRB. There is no 7-year accumulation principle for residence NRB. Okay, now the next step is normal NRB. We all know in this question normal NRB at the time of death was 325,000 available. Yes, 325,000 available. But you know, for residence NRB you have to look 7 years back. You have to look 7 years back. And as this is death state, calculation, so you will stand at the date of death and you will look 7 years back. So yes, 7 years back there is big elephant. This big elephant of CLT 48125, this giant CLT is there. So obviously this CLT must have consumed your NRB. So no more normal NRBs available. No more normal NRBs available. So what you do, 2 million less 150,000 is 1,850,000. Now the question is, sir, what is the tax rate on death? There is only one tax rate, that is 40%. Okay, 1,850 times 40%. 1,850 times 0.4 is 740,000. This is 740,000. Look at the working, just giving you 10 seconds. And don't think about taper relief now. Don't think over taper relief, because there is no taper relief on death state. Taper relief is only available for PAT and CLT. Are you getting? Please reply on chat box. Come on, come on, one quick reply, one quick reply in chat box. I need engagement, I need engagement, please. One single reply on your chat box. Okay, now one last question for IHT, and then we have to move for VAT. Okay, because we have very restricted time and there are a lot of things. So your next question is AFIA. AFIA. I hope you remember the rules. Let me tell you, IHT is calculated on decrease in wealth of donor. IHT is calculated on decrease in wealth of donor. And I taught you in the beginning, in the very first slide, how to calculate decrease in wealth of donor. There were two lines. Wealth of donor before gift, less wealth of donor after gift. Okay, let's do it. Afia died on 29th November 2019. Don't forget this date, important date. This is the date of death. She had made number of gifts during her lifetime as follows. The first gift. Afia's first gift was made on 14 September 2014. 14 September 2014, when she gave 6,500 pound one ordinary shares in Cassava Limited, an unquoted investment company, to her daughter. Per gift to person, this is pat. Gift to person, this is pat. Now sometimes like this question, you have to calculate the decrease in wealth of donor. In sometimes they give you ready made, and sometimes you have to calculate the decrease in wealth of donor. Let's calculate. Now, before the transfer, my dears, before the transfer, Afia owned 8,000 shares, 8,000 shares out of Cassava Limited 10,000 ordinary shares. Now hold, just think, there is no gift right now. Here she has not given any gift, so she had already had 8,000 shares. So for the first line, that is wealth of donor before gift, we will be using 8,000 shares. Okay, and tell me, 8,000 shares is 80% of 10,000, right? 8,000 shares is 80% of 10,000. That means his existing holding is 80%. Okay, now on 14 September, Cassava Limited shares worth £3 for 15% holding, £7 for 65% holding, and £8 for 80% holding. Very, very easy. Don't ruin it. Don't ruin it. Go slow, 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 slow. You will get it. Now wait. She already had 8,000 shares. No, she has not given any gift right now. She has not given any gift yet. She's planning. Okay, so right now she has 8,000 shares, and 8,000 means 80% holding. And what's the market value of 80% holding? Is pound 8 per share. Okay, let's start. See the screen, the first line. Wealth of donor before gift. Wealth of donor before gift. Sorry, the writing is a little bit small. She already, first look at the first line, she already had 8,000 shares. And what's the worth of these 8,000 shares? 80% holding, it's pound 8 per share. So 8,000 times pound 8, 8,000 times pound 8 is 64,000. 8,000 times pound 8 is 64,000, right? Less. Now wealth of donor after gift. Now just think, from 8,000, she just gifted 6,500 shares. From these 8,000 shares, she just gifted 6,500 shares. Now what quantity she has now? Only 1,500 shares. She has only 1,500 shares. So now wealth of donor after gift will be calculated on 1,500 shares. My dear student boys and girls, 1,500 shares means 15% holding. 1,500 shares mean 15% holding. So for 15% holding, look at the screen, the share price is £3 per share. So what will be the wealth of donor after gift? It's 1500 multiplied by pound 3. 1500 multiplied by pound 3 is 4500. Now simply deduct 64,000 minus 4500 is 59,500 is 59,500. This 59,500 is your pat. This 59,500 is your pat. Okay, why is your pat? Because she didn't give this to trust, she gave to directly to daughter. She gave this gift directly to daughter. Okay, so 59,500 is the amount of pat before any annual exemptions. Before any annual exemptions. Let's see what's the examiner is asking. Come on, let's see. Please concentrate, boys and girls, concentrate. What is the, see, what is the gross chargeable, I'm reading question number 1. What is the gross chargeable transfer value after all exemptions? After all exemption means we have to deduct, annual exemption as well. We have to deduct annual exemption as well. If you see, my dear, if you see, before 14 September 14 means 14-15 fiscal year. 14 September 2014 means 14-15 fiscal year. Can you see any gifts in last fiscal year? Can you see any gifts in last fiscal year? No. So that means last fiscal year 3000 annual exemption and this fiscal year 3000 annual exemption. So 3 and 3, 3 plus 3 is 6000. 3 plus 3 is 6000. Okay, so what is the amount of annual exemption which we are going to use? Is 6000. Okay, so 59,500 minus 6 is 5 is 53,500. 53,500 is 53,500. Okay, right? So this is your answer. So this is your answer. 53,500 is the answer of question number 1. 53,500 is the answer of question number 1. Okay. Okay. Right. Now you may ask, sir, what about the marriage exemption? There is no marriage exemption right now because nothing is written about marriage or wedding. Right. Right. Now next point number 2. Point number 2. I'm reading point number 2. ACCA then made various other gifts such that on 26 January, one more thing, just think ACCA is alive right now. In these stories, ACCA is alive, no more dead, right? ACCA then made various other gifts such as at 26 January 2019, the total gross chargeable value of all transfer made in the previous 7 years, see, in the previous 7 years was 220,000, comprising potentially exempt transfer of 100 and chargeable lifetime transfer of 120. I have a question. She is not dead right now, she is alive, and they are saying in last 7 years she did pat of 100,000 and CLT of 120,000. She did pat of 100,000 and CLT of 120,000 in last 7 years, and he's alive, she's alive, sorry, she's alive. Can you tell me out of these 100 and 120 which event is chargeable? Which event is chargeable? Only CLT, because if she's alive there is no tax on pat. In if she's alive there is no IHT is computed on pat. Okay, so in last 7 years, they have only computed, they have only computed IHT on 120,000, not 100,000. Okay, so if we need to calculate any IHT on CLT now, and you have to see last 7 years, so in last 7 years only 120,000 is chargeable. In last 7 years only 120,000 is chargeable. Okay, I think for 1 second my internet got disconnected, but it's okay right now. Now, let's on third. Wait, 1 second. Wait a minute, please. हाँ वो 1 सेकंड के लिए डिस्कनेक्ट हो गया था शायद. अब हो गया ना? ठीक. ओके, थैंक यू. Now, point number 3 is connected to point number 2. Point number 3 is connected to point number 2. On 27th January 2019, AFIA made a transfer value after all exemptions. Thank God, annual exemption now already deducted, of 400,000 to a trust. This is CLT. 400,000 to a trust. This is CLT. Okay. AFIA paid the inheritance. AFIA means donor. The inheritance tax arising from this gift. That means lifetime IHT on CLT. Lifetime IHT on CLT for this event will be paid by donor. What will be the consequences? Number one, first of all, you have to use the tax rate of 25%, and second, you have to do grossing up. But my dear students, look at this date. This is 27 January 2019, and this is 26 January 2019. So they have clearly said that in last 7 years, there is one CLT of 120,000. So that CLT must have consumed your NRB. Okay. So for NRB deduction, you have to deduct 1,20,000. Don't forget. Okay. Let's read the third requirement. What they are asking. Sorry, second requirement. How much lifetime IHT is payable? How much lifetime IHT payable on the gift to the trust on 27 January 2019? On 27 January 2019. If you go slow, you will understand. Listen. Okay. This is the working. The amount of CLT was 4 lakh. The amount of CLT after all exemptions, that means already annual exemptions deducted, was 4 lakh, right? And you can see in this 1920 or 1819 fiscal year, your normal NRV is 325,000. Your normal NRV is 3,25,000. But always, dear students, for NRB is always for 7 years. NRB is always for 7 years. So you just see 7 years back. You see 7 years back. And in 7 years, in last 7 years, yes, you calculated tax on something. There was some CLT. We just read the question. And that CLT was 1,20,000. Okay. So you have to reduce your NRB with 1,20,000. So 325,000 less 120. 325,000 less 120 is I think 205. Yes, 205. Okay. So deduct 4 lakh, deduct 205,000 from 4 lakh, it will be 195,000. And now as the donor APIA is paying the lifetime IHT, so the tax rate will be 25%. So 19,500 times 25%, what is the number? 9. Let me calculate it. Wait. It's 48750. That's it. 48750. You can see. Screen is in front of you. 48750 is the answer. The answer of question number 2 is 48750. It's not that difficult. Just trust on yourself. Be confident. Okay. Now, this is a general question. Question number 3, general question. Come on. Which 4 of the following items will be included in or deducted from? In short, it means it's relevant to death state. Which 4 of the following items is relevant to death state? So listen. Main residence, yes, obviously you include main residence. Funeral expenses, yes, you deduct funeral expenses. I taught you. Unpaid gambling debts, no more gambling debts, no more gambling debts, because you don't receive any consideration in the life. Shares held in individual savings account, yes. Also, individual saving account is exempt asset for CGT purpose, but for IHT it's not exempt. For IHT it's not exempt. Then 10,000 held in guilds, yes, you have to add. Guild, you have to add, definitely you have to add. Even the guild is exempt for CGT but not for IHT. Endowment mortgage, never. Endowment mortgage is never deducted from that state, because we are no more responsible for paying this endowment mortgage. Insurance company pays this. Insurance company pays this. Okay. Okay. So this was easy part. Done. Now I will teach you something new which I didn't teach you right now in the revisions. One new topic, that is transfer of NRB. Transfer of NRB. Look at me. Transfer of NRB. You know what if husband or wife, one of them died first. For example, wife died first and then after a few years husband died. So if wife had any unused NRB, listen carefully, wife had or wife left any unused NRB at the time of death, so husband death tax is working, we can use that unused NRB. But how? First step, first you have to calculate, first you have to go 10 years back. Let us say wife died 10 years back. Let us say wife or husband died 10 years back. So you have to go 10 years back and you have to calculate, listen my words, important words, you have to calculate the unused NRB percentage. You have to calculate unused NRB percentage using the old data, and that unused NRB percentage will be applied on new NRB of today's, that is 325,000, and you can claim that NRB. This is the law, this is the rule, very important. Even examiner wrote this in his comments as well. Again repeat. For example, Afia is a lady, so husband died 10 years before. Okay, so you should go 10 years back, and using the 10 years back data, the old data, first you have to calculate the unused NRB percentage, using existing data, and that unused NRB percentage will be applied on new latest NRB of 325,000, and then you can claim that. Okay, this is the first thing. Second, one more thing I taught you today, residence NRB. If husband died 10 years back and he didn't use any residence NRB, and obviously there was no residence NRB at that time, so no issue, that means he didn't use residence NRB, so that residence NRB can be claimed on wife's death, provided wife is meeting all the conditions which I taught you. provided wife is meeting all the condition which I taught you. Okay, so now be very careful. Don't look here and there. Look at me with full concentration. Come on, this paragraph. Let me zoom the screen. Afia's husband. See, this is the story. Afia was the real lady. Now, Afia's husband had died on 1st June 2008, almost 12 years back, leaving an estate valued at 2 lakh. He left 46,800 to daughter. Yes, this is the chargeable thing. If you leave anything for your daughter or son, this is chargeable. And the balance to Afia. Husband wife transfer, spouse exemption. Husband wife transfer are never chargeable at all. So at the time at the time of his death in 2008, the only chargeable estate was 46,800. The only chargeable estate was 46,800. Now wait, he had never made that husband, he had never made any gifts during lifetime. No more pet, no more CLT of husband. So just think, at the time at the time of husband death in 2008, the only chargeable estate was 46,800. Now wait, we are going back 12 years back. The nil rate band, look at here, the nil rate band for the tax year 0809 is 312. In the year husband died, that is 89, that is 0809, that is 2008. At that time, what was the NRB? The NRB at that time was 312. Now you just think, please look at me. Out of this 312, how much amount must be used? How much amount must be used? Only 46,800. Only 46,800 was chargeable at that time. Only 46,800 was chargeable at that time. That means there was some amount unused at that time. There was some amount must be unused at that time. So first you have to calculate that unused percentage. First you have to calculate that unused percentage, and then you have to apply that percentage in today's time. I'm just silent 10 seconds, you read it. 10-20 seconds, you read it, please. Shh. Okay. This. Just read the requirement first. What is the total amount of nil rate band? What is the total amount of nil rate band? And they have written S, maybe 2 nil rate bands that Afia could claim in respect of unused nil rate band on the death of her husband. That means how much will be transferred to Afia, not Afia's own. Just talking about the husband's NRB which she can use at the time of death. Let's do it. When husband died in 2008, the total NRB at that time was 312. When husband died in 2008, the total NRB at that time was 312. Husband used only 46,800. Use your calculator. So at that time the unused amount was 265. At that time the unused amount was 265,200. Okay, now let's calculate the unused percentage. Look at there, look at here. Total NRB at that time was 312, out of which 265,200 was unused. Total NRB at that time was 312,000, out of which 265,200 was unused. Can you multiply by 100? This percentage is 85%. This percentage is 85%. Okay. Now you calculated the 85%. This 85% you have to apply on the current data. On the current data right now, the NRB is 325,000. So 325,000 times 85% is 276,250. 276,250. This is the normal NRB which she received from her husband. I'm quiet for 30 seconds because of Azan. Now, so we calculated unused percentage using existing data 12 years back, and we applied it on the new NRB of 325,000. So one thing, please look at me. One thing, the normal NRB she received from husband is 276,250. Now, you just read the story. At that time, the husband didn't have any main residence or anything, so definitely his residence NRB is also unused, so residence NRB will also be transferred. Residence NRB will also be transferred to wife, so that is 150,000. So total NRBC, total NRB she can use from the deceased husband is 426,250. See, 276,250 plus 150,000. 276,250 plus 150,000. That is 426,250. Okay, the total NRB. Now the question is, sir, did Afia met the condition? Did Afia herself met the condition of residence NRB? Yes. You can read the question. You can read the question. Let me show you. Let me show you. See these lines. Wait. On her death, these lines, see. On her death, Afia left an estate valued of 525,000, including her main residence worth 375,000 to her children, downward to her children. Okay, going downward in the generation. Main residence plus she died. Afia died after 6th April 2017. So all conditions of residence NRB was met by Afia, right? Okay, that's why she can use her husband as well, husband's residence NRB as well. Okay, so the answer for question number 4, the answer for question number 4 is for what is the amount, what I told you, I think it was, wait, 426,250, that is D. Okay, now we are taking Maghrib prayers break, 6 to 7 minutes Maghrib prayers break, and then we'll do this last part, this fifth part, very simple, it's a date, and then we'll do value added tax. Okay, so be active, get yourself refreshed in this break, 6 to 7 minute break for you guys. Okay, welcome back for this last session now, for this last after break session. now now we have to revise one thing here, the payment date of taxes. Okay, for both the lifetime IHT, for both the lifetime inheritance tax on gift to the trust on 27 January 2019, and the tax arising on AFIA's estate, select the due date payment from the following. First of all, giving you a good recap, listen. For all death taxes, death taxes means IHT on PAT, additional IHT on CLT, feel it, additional IHT on CLT, and the third thing is IHT on death state. For all death taxes, there is one due date. For all death taxes, there is only one due date. And what is that due date? 6 months, 6 months from the end of the month, from the end of the death month. That's it. 6 years from the end of the month in which the person died. Okay. So in this question, tax on state, sorry, tax on death state. Tell me the date of death. I think the date of death was November. Wait, the date of death was November 19. Let me check. The date of death was 29th November 19. 29th November 19. Okay. So easy thing first. Easy thing first. 29th November 19. Just end the month. Just go to end of the month of November. That is 30th November, and now count 6 months. After November, December, January, Feb, March, April, and May. So the date is 31st May 2020 for this. 31st May 2020. 31st of May 2020 for this. 31st May 2020 for this. Okay, right? 31st May 2020 for this death state tax. Okay, so this was for the death state. Now there is one tax which is paid when you are alive. There is one tax which is paid when you are alive, and that is lifetime IHT on CLT, lifetime IHT on CLT, and that is a little bit technical, little bit not technical, it's lengthy. Okay, and in that case you have to go for two dates. You have to mark two dates and opt the later date. First of all, first tell me the date of this CLT. The date of this CLT is 27th of January 2019. Wait, the date of this CLT is 27th January 2019. Okay, identify the fiscal year. Come on, 27th January 2019 falls in 1819 fiscal year. 27th January 2019 falls in 1819 fiscal year. Okay, now let me tell you the first date. The first date is 30th April. The first due date is 30th April following the end of tax year, following the end of tax year in which gift arises. So gift arise is in 1819, and after 1819 the 30th April is, with 30th April comes, that is 30th April 2019. 30th April 2019. So first of all, this date, keep it in mind, this date, 30th April 2019. Now second date, listen. 6 months from the end of the month in which gift arises. 6 months from the end of the month in which gift arises. Gift arises in January. Gift arises in January 2019. Gift arises in January 2019. Now end the January, come to end of January and count 6 months. After January, Feb, March, April, May, June, and July. So the second date is 31st of July 2019. The second date is 31st July 2019. My dear student, these are the two dates. These are the two dates we have calculated: 30th April 19 and 31st July 19. Yeah, now you tell me which date is later. Which date is later? This is later. So this will be your due date. This will be your due date for lifetime IHT. This will be your due date for lifetime IHT. That's it. This will be your due date for lifetime IHT. Okay, so that's the end of our IHT, and now we are moving towards the value added tax. Now we are moving towards the value added tax. Be very active. Value added tax is also very important and very logical theoretical area. Logical theories are there in that topic. Come on. Value added tax, the first thing related to value added tax, this is indirect tax. The first you studied a lot of direct taxes. What is direct taxes? For direct taxes, the burden is to be borne by the person who is earning the income, right? And for indirect taxes like value added taxes, the burden is to be borne by the one who consume the end user. Okay, now the first thing, please look at me. The first thing, tax department divides goods and services into three categories. Tax department divides the goods and services into three categories. The first is standard rated goods. The first is standard rated goods. What are standard rated goods? Look at me, look at me, look at my video, please. Listen. Let us say government marked this pen as standard rated goods. Okay, so now if you do any expenses, if you incur any expenses or you buy inventory to make standard rated goods, and you pay any VAT on this standard rated goods in making of this standard rated good, you can easily claim input VAT. Yes, you can easily claim input VAT. And the second thing, and when you sell, look at me please, boys and girls. When you sell this standard rated goods, when you sell this standard rated good to any customer, you will charge normal 20% output VAT from that customer. Okay, so what is standard rated good? I repeat, let us say this pen is standard rated, so if you buy any inventory or you incur any expenses related to in making of this standard rated good, and you paid the VAT, so you can easily claim that VAT. You can easily claim input VAT. But when you sell this standard rated good to the other customer, you will also charge normal 20% output VAT. Read the lines, I have written all this. Okay, now the second types of goods and services are zero rated. What do you mean by zero rated? Please be active, please, my dear students, look at me. Zero rate. Let us say government made this pen zero rated. Government stamped this pen as zero rated goods. Okay, now whatever expenses you incur, or whatever inventory to buy, or you incur any expenses in making of this zero rated goods, and you paid VAT, whatever VAT you have paid in making of this zero rated goods, you can easily claim input VAT. Yes, you can claim input VAT for the preparation of zero rated goods. Yes, but when you sell zero rated goods to any party, you won't charge any output VAT. You won't charge any output VAT from that party. Okay, the third the third the third types of supplies are called exempt supplies. The third type of supplies are called exempt supplies. Okay, what is exempt supplies? Listen. Let us say government made this pen exempt. Now if you incur any expenses, or if you pay, and if you have paid any VAT in making of this exempt good, and you paid VAT for the making of this good, you cannot claim input VAT. You cannot claim input VAT, the first thing. And when you sell this exempt good to the third party, you won't charge any percentage output VAT from them. Okay, so you must know these three categories. Now for your information, standard rated and zero rated goods are collectively called taxable supplies. Standard rated and zero rated goods are collectively called taxable supplies. Don't forget. Okay, now one thing, registration. No, one thing is registration. Okay, first of all, if you have your pen and paper, you can write 2 lines. Only registered trader, write few lines. Only registered trader can charge output VAT on sales. Only registered trader can charge output VAT on sales. What does it mean? For example, I am a seller and you are a buyer, and I am not registered with the tax department. I am not authorized with the tax department, and I am charging value added tax from you guys. So this is a crime. This is basically a crime. I'm not authorized. I'm not authorized. I'm not the agent of government, and still I'm charging VAT from you guys. That means this is a crime. Crime. I'm a liar then. Okay. So only registered trader can charge output VAT on sales. The second line. Now write the second line. Only registered trader can claim input VAT. Only registered trader can claim input VAT. That means if you want to claim input VAT, first of all, you must be registered. First of all, you must be registered. Unregistered guys are not allowed even to enter in the tax department. Unregistered guys are not allowed to enter in the tax department. These are very basic things. I'm sure you know this before. Now, what is the topic of registration? There are 2 types of registration. There are 2 consequences of registration. Number 1 is compulsory. Compulsory means that you have no option. Once you reach a limit, you have to register, right? Okay. Now, the first of all, we are doing compulsory registration. Compulsory registration, there are 2 tests. For compulsory registration, there are 2 tests. For compulsory registration, there are 2 tests. Look at here. One is historic test and the second is future test. One is historic test and the second is future test. One is historic test and the second is future test. Okay. Now, what is historic test? What is historic test? Let me tell you with numbers, and you all have to support me. Okay, listen. For example, I started business on 1st January. I started business on 1st of January. Listen, in the first month, my taxable supplies is only 2000. Only 2000. Now look at this number, 85,000. Look at this number, 85,000. Okay, one thing. Just confirm me on the WhatsApp group that the compulsory registration limit is 85,000 or 83,000. Can anybody confirm on the WhatsApp group? On the WhatsApp group, confirm me, because I'm not sure right now. It's 85 or 80, in previous years it was 83. It's 85,000 or 83 for compulsory. Okay, 85, right? Okay, done. Thanks. Now, listen. You started business on 1st of January. You started business on 1st of January, right? Now you have to check this your sales. In the first month, the sale is only 2000. In the second month, 2 plus 2, it's 4000. Still, it's less than 85. Then add 1. 4 plus 1, 5. 5 plus 2, 7. 7 plus 3, 10. 10 plus 4, 14. 14 plus 5, 19. 19 plus 6, 25. 25 plus 2, 27. 28, 30, and 31. See, 12 months have passed. 12 months have passed, but still you didn't cross. Still you didn't cross how much? 85. So what's the total sales of this 12 months? Is 31. Is 31. Okay, did I calculate 31 right? You can also you have to help me in this addition. Okay, sometime I forgot. Now, once 12 months has done, 12 months has gone, and still you haven't crossed 85. So now you will add one new month and you subtract one old month. You add one new month and you subtract one old month. So you will, what's the new sales? 20. You will add 20. You will add 20 and you will subtract 2. You will add 20 of January and you will subtract 2. So 31 plus 20 is 51, less 2 is 49. 49. Dear student, still you haven't crossed, 85. Okay, add one more month, add one more new month, and deduct one last old month. So 49 plus 40, the sale of this new month is 40. 49 plus 40 and minus 2. What is the number? Tell me. 49 plus 40 is 89, minus 2 is 87. Okay, 87. Now listen my commentary. Listen my commentary, please. Listen my commentary. Look at here. At the end of Feb, the trader realized that at the end of Feb, the trader realized that his last month, that his last 12 months, taxable supplies, taxable sales crossed 85,000. At the end of the Feb, trader realized that his last 12 months, taxable supplies crossed 85,000. Now, what he has to do? At the end of Feb, now he has 1 month. He has 1 month to apply. That means the whole March. He has to apply. For registration to tax department by the end of March. Okay, and tax department will make him active registered person from 1st April. Okay, I repeat my words. At the end of Feb, trader realized that his last 12 months, taxable supplies crossed 85,000. Now what he has to do? He has 1 month. From the end of Feb to apply for registration. That means he has to apply before 31st March, and tax department will make him active registered guy from 1st of April. So this is basically historic test. Okay, now there is one more test which we call it future test, which is future test. And future test is only for 1 month. Future test, you can listen orally. Future test is only for 1 month. If in any 1 month, listen, future test is not for 12 months, is only for 1 month. If in any 1 month your taxable supplies crossed 85,000, then before the end of that month you have to apply. For registration, and tax department will make you active, registered guy from the beginning of that month, from the beginning of the same month. This is what we call future test. So there are two compulsory tests. One is historic test and the second is future test. Okay, now listen. This is what is compulsory registration. There is one more option, that is voluntary registration. Voluntary registration means that you are not up to 85,000 guy. You are your status is less than 85,000, but still you wish to register yourself. Still it's your heart wants to register. You want to be a registered guy. Okay, go and get yourself registered. But before doing voluntary registration, don't forget some consequences. That let's look at here. That after be a registered guy, your products will be expensive to customers. And especially if your customers are general public. Then they might shift to other shops. Okay, so be careful with voluntary registration. Now there is one thing which we call VAT period. There is one thing which we call VAT period. VAT period is quarter. That means we have to present ourselves. In front of tax department after every quarter. Say for example, your VAT period is January, Feb, March. So for this quarter, what is the due date? For VAT payment? after the end of the quarter, 1 month 7 days, 1 month 7 days, 1 month plus 7 days, 1 month plus 7 days, 1 month plus 7 days. That means for this quarter, January, Feb, March, the due date for VAT return filing and VAT payment is 7th of May. 7th of May. So don't forget, VAT reporting is normally done on quarterly basis. And what is the due date is 1 month plus 7 day after the end of that quarter. 1 month plus 7 day after the end of that quarter. Okay, right? Okay. Now, there is one thing which we call surcharge period. Surcharge period. There is one thing which we call surcharge period. There is one thing which we call surcharge period. What is surcharge period? Listen. For example, for example, in for last many years, you are an up-to-date guy. Up-to-date guy means you pay your VAT on time and you file your return. You file your VAT return on time. You pay your VAT on time and you file your return on time. Listen, listen. But for the quarter ended March, this is January, Feb, March. January, Feb, March. First time in your whole life you did a mistake. First time in your whole life you did a mistake. Open your eyes. What you did, you paid VAT late, you paid your VAT late for this March quarter, okay? Or you paid the return late. One of the mistake. Normally these two things are done on the same day. Normally these two things are done on the same day. So for the quarter ended March, let us say this is 019. For the quarter ended March 19, for the first time in life you paid VAT late or you filed the return late. So what will be the consequences with the first mistake? They just say don't do it again, and they give you a warning. They give you a warning. So they make a surcharge period. They put you in a web. They put you in a web of surcharge period, that watching period. They say we are watching you. Okay, so when you do mistake for the first time in the life, the just a surcharge period is extended for next 12 months. That means now you have to spend your life in surcharge period. Okay, now as you are a human being, so you did mistake, you did mistake again for the quarter ended, June. You did mistake again. That means after initial warning, this is your first mistake. After initial warning, this is your first mistake. So what will happen? Now your surcharge period will be extended for next 12 months and you have to pay 2% penalty. You have to pay 2% penalty. Okay. Now, if you repeat your mistake again your surcharge period will be extended to 12 months from the end of that quarter, and then you have to pay 5%, then 10%, and so on and so on. Okay, hope you remember this surcharge period topic. Sometime it comes. Okay, now this is something very important and something very technical for students as well. I will give some time on this topic. Okay, surcharge period, I just gave you a quick recap. Don't forget, these are revision days. These are not normal classes. Please don't forget this thing. And it's a very big course. Now, tax point. First of all, try to understand what is tax point. We all know this. We all know this. For January, Feb, March, we all know this thing, that for January, Feb, March quarter transactions, we have to pay VAT on 7th May. I just told you. I repeat, we all know this. For January, Feb, March quarters transaction, we have to pay VAT on 7th May. This we already know, we have studied. But for which transactions? Cash sales, credit sales, what is the criteria? I mean, how you will recognize that which transactions to be included in which quarter? For VAT purpose, which transactions are to be included for January, Feb, March? For this purpose, you have to calculate tax point. You have to calculate tax point for each and every transaction. If the tax point for any transaction lies in January, Feb, March, if the tax point for if the tax point for any transaction lies in January, Feb, March, that means that transaction belongs to January, Feb, March. That means that transaction belongs to January, Feb, March, and for that transaction you have to pay VAT on 7th May. Got it? So from now onwards, be very watchful on this tax point. For every transaction you have to think about tax point, whether the tax point lies in this quarter or not. If the tax point lies in that quarter, then yes, that transaction belongs to this quarter, otherwise no. Okay, now the question is, sir, how do we calculate the tax point? It's not difficult. You have to concentrate, please. You have to concentrate. How do we calculate the tax point? I'm telling you the tax point for goods right now. Tax point for goods. Look at me. First of all, my dear students, you have to calculate BTP, basic tax point. First of all, you have to calculate BTP, the basic tax point. Look at here, my video. Basic tax point is the day. Basic tax point is the date when you deliver your goods. Basic tax point for goods is the date when you deliver your goods to customer. So let us say this is your BTP. You mark it BTP. Okay, you mark the BTP, the date you delivered goods to customer. Now, second thing you have, if payment is received before BTP, if payment is received before BTP, then the receipt date is your actual tax point. For example, if you have received advance here, if you have received advance payment here, then for this advance payment, your ATP is the date advance received. ATP is the date when you receive the advance. ATP, your actual tax point, is the date when you receive the advance payment. Okay, but let us say, just assume we haven't received any advance, or we just received 50% advance. We just received 50% advance, so 50% transaction has already been accounted for using ATP on the advance date. Now the last thing, come again to BTP, and there is a 14 days rule. Come again to BTP, there is a 14 days rule. You have to check whether you have issued invoice in next 14 days, whether you have issued invoice in next 14 days from BTP. If yes, then the invoice issuing date will be your actual tax point. Invoice issuing date will be your actual tax point. And if you are very smart, or you are trying to be very smart with tax department, and you are issuing VAT invoice late, means after 14 days, 15, 16 days, 18 days, 20 days, then in that case your BTP will be your ATP. In that case your BTP will be your ATP. I repeat, no issue. I'm repeating. First of all, you have to check BTP. BTP, basic tax point, is the date when you deliver the goods. Basic tax point is the date when you deliver the goods. You mark it. Second thing, you have to check whether you have received any advance. If yes, if you have received any advance, then the advance receiving date will be your actual tax point for that advance amount. Okay. Third step, again you come to basic tax point, and you check that whether you have issued the invoice within 14 days of BTP. If yes, then invoice issuing date will be your actual tax point. If no means you are issuing invoice late, you are trying to be very smart. So tax department says don't be very smart, and then your BTP will be your ATP. Now, you might have studied You definitely, sorry, using wrong word, you definitely studied these three schemes. There are three schemes in your VAT, value added tax topic: annual accounting scheme, cash accounting scheme, and flat rate scheme. There are three schemes in your course for payment of tax: annual accounting scheme, cash accounting scheme, and flat rate scheme. What is annual accounting scheme? First of all, annual accounting scheme for is for those traders who can't bear the burden, who can't bear the administrative burden. Because if you don't apply annual accounting scheme, you have to pay four VAT returns every year. Because the normal reporting is quarterly reporting, we have just studied the normal reporting is quarterly reporting. So just think, there is a company and they are very busy people, they don't have time. So normally they file their return late. Normally they file their return late, and when they file their return late, they have to bear the consequences of surcharge period. They have to bear the penalties of surcharge period, and that is very damaging for them. So one day that manager called tax department that we are not happy with you guys, we did mistake by doing registration. So tax department said that for busy people like you, there is an excellent scheme for you guys, and that is annual accounting scheme. There is an excellent scheme for you guys, that is annual accounting scheme. Now, first clear one misperception. First clear one misperception. People think annual means there is only one tax payment. No, no. Annual does not mean one tax payment. Annual means only one tax return. Annual accounting scheme means you have to file only one tax return. Annual accounting scheme means you have to file only one tax return every year. Okay, so the first advantage of this scheme, you don't have to file four tax return, only one tax return for to be filed. That means your administrative burden will be reduced. Now the next thing, please look at me. These are very key areas. If you want to operate, if you want to practically solve annual accounting scheme, always first point out the date of joining the scheme. Always first point out the date of joining the scheme. Let us say in my example, this example is made by me. In my example, I'm saying that I joined the scheme on 1st January. In exams, maybe they give you a different date: Feb, March, April, any date. In my example, I'm saying that I joined the scheme on 1st January. I joined the scheme on 1st of January. Okay, so what you have to do in this scheme, when you join this scheme, you have to pay VAT through POA, payment on account. You have to pay VAT through payment on account. Payment on account means this payment on account is calculated on the basis of last year VAT. This payment on account is calculated on the basis of last year, the last full year actual net VAT payable. Okay, so this is the scheme joining date, and in the question you will have ready-made last year's actual net VAT payable is 1 lakh. So how will you calculate your POA? How will you calculate your POA? Payment on account, just simply last year net VAT payable multiply by 10%. Just learn this 10%. This 10% you have to learn. 100,000 times 10% is 10,000. Okay, 100,000 times 10% is 10,000. Okay, first of all you have calculated POA. Now how to operate? From the scheme joining date, count 4 months. Let us say I joined the scheme from January. So from the 4th month, January, Feb, March, April, this 4th month you pay first POA, then second POA, then third, then fourth, fifth, sixth, 7, 8 and 9. Open your eyes. How to pay POA? From, let us say we joined the scheme on 1st of January. So from the 4th month you have to start paying POA. We joined from January, so the 4th month will be April. So April, May, June, July, August, September, October, November and December. Total 9 POA we have made. Okay, with reference to last year. And what is the total of 9 POA in this question? 10,000 per POA. 10,000 per POA multiplied by 9 is 90,000. 10,000 per POA multiplied by 9 is 90,000. Okay, right? Now you have to calculate balancing payment. Now you have to calculate balancing payment. Just think that the whole year has been passed, so you also got the actual VAT payable for this year. You also got the actual VAT payable for this year. Like, let us say the actual VAT payable for this year came out to be 1,40,000. The actual VAT payable for this year came out to be 140,000. The actual VAT payable came out to be 140,000. Now you just think your actual net VAT payable to government is 140, but you have already paid some amount through POA. How much amount you paid through POA? 10,000 multiplied by 9 payments, so 90,000. 90,000. 140 minus 90, so your balancing payment will be, your balancing payment, my dear student, will be 50,000. Okay. Now students may ask, respected sir, kindly tell me what is the due date of this balancing payment. Kindly tell me what is the due date of this balancing payment. Okay, so from the end of after, see, we joined the scheme on January. So after completing 12 months, we joined the scheme on January. After completing 12 months, you have 2 months. That means end of Feb, you have to pay the balancing payment plus VAT return, balancing payment plus VAT return. Now you can see this big picture. Now you can see this big picture. This big picture says only one VAT return, only one VAT return in the whole year. So automatically, this is the advantage of this scheme, that your administrative burden will be reduced. That your administrative burden will be reduced. Okay, right? And don't forget, if you are in this scheme, then you have to pay VAT through POA. If you are in this scheme, if you are following this scheme, you have to pay VAT through POA. And how POA is calculated? Using the last year's actual net VAT payable, using the last year's actual net VAT payable, right? One more thing, and that you must have done the conditions. Don't forget these numbers, conditions. If you want to enter in this scheme, first of all your old dues and all, everything is up to date, you are cleared guy. Number two, when the day you are entering, the next 12 months, your expected taxable turnover must be less than 1350, 1.35 million. 1.35 million. This 1.35 million is the next 12 months expected turnover. And very dangerous thing is 1.6 million. Let us say by any means you entered in this scheme, but if your first 12 months actual sales, if your first 12 months actual sales cross 16 lakh, if your first 12 months actual sales cross 16 lakh, then what they will do, they will look at it, they will pick you and they will throw you out of the scheme. They will pick you and they will throw you out of the scheme. They will throw you out of the scheme. Right? Now see, I've written annual accounting scheme beneficial for those who can't file return on time. Now the second scheme. Now the second scheme, boys and girls, we have cash accounting scheme. We have cash accounting scheme. What is cash accounting scheme? In very short, I am explaining you in very short. Listen. Cash, if you come to cash accounting scheme, all theory, read the line, all theory of tax point becomes null and void. I taught you the theory of tax point, the invoice date, the BTP, everything becomes null and void. Forget it. If you apply cash accounting scheme, your tax point becomes your receipt date. Your tax point becomes your receipt date. That means if you receive cash from your customer, then pay to government. If you receive cash from government, then pay to government. No need to pay on invoice basis. No need to pay VAT from your own pocket. No need to block your money. So what are the advantages of this? Advantages of cash accounting scheme? Number one, automatic bad debt relief. Automatic bad debt relief. I hope I'm teaching students right now. You guys are next month is your paper. Next month is your paper. So you have studied something. Definitely you have studied a lot. There is a topic which is called bad debt relief. In normal circumstances, when you even when you don't use cash accounting scheme, still you get bad debt relief. Still you get bad debt relief. But I hope you remember, for bad debt relief you have to wait for 6 months. For bad debt relief there is a condition. I hope you remember. I hope you remember. There is a waiting period of 6 months. So still the 6 months is not a good time. Who can wait 6 months? I can't wait 6 months. So in cash accounting scheme, the rule is, if you get cash from customer, then pay to government, otherwise don't pay. So no need to block your payment. So automatic bad debt relief is there. Automatic bad debt relief is there. And second point, try to use your brain now. Beneficial for trader. It is highly beneficial for trader doing credit sales on high credit terms. There are sellers who sells on who give long credit to their customers, who give long credit to their customers. So they normally deliver goods now and they collect after 4 or 5 months. So if they shift to cash accounting scheme, automatically their VAT payments will be deferred. Their VAT payments will be deferred. So there will be some cash flow benefit for them. There will be some cash flow benefit for them. Okay. So in short, let me summarize it. In short, cash accounting scheme is beneficial for those guys who are doing credit sales. In short, cash accounting scheme is beneficial for those guys who are doing credit sales. Okay. Now, one thing I forgot to tell you, for cash accounting scheme, the conditions 1,350,000 and 16 lakh, 1.35 million and 1.6 million limits are same. So the limits for cash accounting scheme and annual accounting scheme is exactly same. Okay. Now the third, now the third scheme. The third scheme is flat rate scheme. Let me give you some introduction, and this is very interesting. Flat rate schemes are for small traders, very poor small traders, not for big people. And the evidence for this is, when I will tell you the limit. The limit is 1,50,000. The limit for annual accounting scheme was 1.35 million and 1.6 million. But for flat rate scheme, the limit is very low, very low. It's around 150,000 and 230,000, 1,50,000 and 2,30,000, right? Okay. Now let me explain you in a different way this scheme. Look at my video, not just the screen, my face. Look at my face. If you join a flat rate scheme, still you're dealing with suppliers and customers will remain same. If you join flat rate scheme, you're dealing with suppliers and customers will remain same. What does it mean? When you buy goods, you will pay normal 20% VAT to suppliers, and when you sell the goods, you will collect normal 20% from customers. Don't forget this. This will come in your MCQ now. In past paper it will come. I repeat, if you join flat rate scheme, you're dealing with people remain same. You're dealing with your suppliers and customers remain same. Means if you buy any goods from supplier, you pay normal 20% VAT, and if you sell any goods to customers, you collect normal 20% VAT. So dealing with customers and suppliers will remain same. But when you go to the tax department, when you go to the tax department, when you go to the tax department, your dealings will be different. When you meet tax department, your dealing will be different. There will be two news. Look at the screen now. There will be two news. One is bad news. When you meet tax department, you will listen two news. One is bad news and one is good news. See, I've used the word bad news and good news. Bad news is here is that bad news here is that you actually paid VAT to your suppliers, that you actually paid VAT to your suppliers, but you cannot claim, any input VAT. Tax department will say bye 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 bye, go go go, we are not giving you any, we are not returning you any input VAT, go go. So this is a bad news. See, you have paid the VAT to supplier, but you are not eligible for any input VAT recovery now. But there is a good news as well. There is a good news as well. And what is the good news? The good news here, that the VAT you collected from your customers was 20%. The the output VAT you collected from your customers is 20%, but you return to government with a lesser rate. You will return that output VAT to government with a lesser rate. So keeping something in your pocket, which is the compensation for input, VAT. Not getting. Read it. Bad news and good news. Read it. Now, for exam, always do two workings. Whenever you see a practical question, of flat rate scheme, normally the question comes with planning area. Flat rate scheme questions sometimes come with planning area. They ask you whether the flat rate scheme is beneficial or not, or not. So what you do, you read these steps. For exam, always do two workings. Number one, first thing, normal workings, and compute net VAT payable. Normal working means normal VAT, make normal VAT return, output VAT less input VAT. What we do normally, you remember, output VAT less input VAT is your normal VAT. Output VAT less input VAT is your normal VAT. Okay, so first of all, calculate net VAT payable using normal workings. And the second, this is the king step. See, this is the king step. Compute VAT payable using flat rate scheme. Now the question is, sir, how to calculate VAT payable using flat rate scheme? This is the area. See, this thing. In flat rate scheme, there is no input VAT recovery. I just told you the bad news. In flat rate scheme, there is no input VAT recovery. Bye to input VAT, and there is only output VAT. But please, very strict words, very extremist word I have to use now. What is the formula of output VAT now? Total sales. See, total sales. Look at here. Total sales inclusive of VAT. Multiplied by flat rate percentage. Total sales inclusive of VAT multiplied by flat rate percentage. Yes. So not only you have to use the total sales, but this must be inclusive of VAT, and multiply by the flat rate percentage, which will be given to you ready made. Now the question of student, sir, I said what, sir, what do you mean by this total sales? This total sales means sum of all sales, standard rated, zero rated, and exempt. Standard rated, zero rated, and exempt, sum of all three sales. Standard, this is the real explanation of this total sales. Although I know and you also know that we haven't collected any output VAT on zero rated and exempt, but yes, you have to include here. Because the flat rate is a reduced rate, basically reduced rate. So output VAT with flat rate scheme, output VAT in flat rate scheme, what's the formula? Total sales inclusive of VAT multiply by flat rate percentage, multiply by flat rate percentage. Okay, so if you get any questions of planning for flat rate scheme, always solve that question 2 times, first normal working and then flat rate working, and whichever option is beneficial you can write, whichever option is beneficial you can write. Okay, okay, now let's do a question, let's do a question, boys and girls, let's do a question. Please, 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 please be with me, be with me. The name of the question is Whitelock Sisters. The Whitelock Sisters, basically a past paper. Sisters Beth and Amy Whitlock trade as a partnership. The partnership has been registered for VAT for many years, and on 1st of January 2020, it began using the flat rate scheme. It began using the flat rate scheme to calculate the amount of VAT, to calculate the amount of VAT payable, to calculate the amount of VAT payable. The relevant flat rate scheme percentage for the partnership rate is 13%. See, ready-made relevant percentage is given. Ready-made relevant percentage is given to you. Okay. Now, for the quarter ended 31st March 2020, the partnership had standard rated sales of 50,000 and exempt sales of 10,000. Now you tell me, and you think 50 plus 10, the total sales is 60. That means if I'm going to work for flat rate scheme, I have to use total sales. If I have to work for flat rate scheme, I have to use total sales. Okay. For the same period, standard rated expenses amounted to 27,300. C. All figures are, thank God, all figures are inclusive of VAT. This is easy thing. All figures are stated inclusive of VAT. Thank God these figures are inclusive of VAT, so we don't need to work any extra thing. Otherwise, if sometime it happens, they give you exclusive numbers, and for flat rate scheme, they give you exclusive numbers. For flat rate scheme, you have to use inclusive numbers in the flat rate formula. Okay. Now, I'm not reading anything after this. These two paragraphs is enough for me. First let me complete the first two questions, and I'm sure you will understand. I'm sure, inshallah. Now, how much, see the question, how much VAT is payable by the partnership for the quarter ended 31st March 2020 if the flat rate scheme is used. If the flat rate scheme is used, now you tell me, boys and girls, when we use flat rate scheme, there are two news. One is bad news and one is good news. Whenever we use flat rate scheme, there are two news. One is bad news and the other one is good news. The bad news here is that you cannot claim any input VAT, so forget about input VAT, forget about expenses. But the good news here is that you have to pay output VAT on reduced rate. You have to pay output VAT on reduced rate. Okay. And what is the formula for output VAT here? See, the formula for output VAT is here is total sales inclusive of VAT. Total sales means sum of all sales. So in this question there are only two sales, that is standard rated and exempt. So 50 plus 60, I think is 60. 50 plus 10 is 60,000. Your total sales is 60,000, and thank God it's already inclusive. Thank God it's already inclusive. So simply multiply it with 13%. 60,000 times 13% is how much? 60,000 times 13%. Let me use the calculator. 7,800. Okay. So your simple answer is 7,800 D. Simple answer is 7,800. Okay. Now, second requirement. Please read between lines. How much VAT would be payable by the partnership for the quarter ended 31st March if the flat rate scheme was not used? That means normal working. Just forget about flat rate scheme. Now do normal working. Now do normal working in normal life. In normal life, look at here. Look at here. I'm doing normal working now. In normal life, you have to pay, you have to collect output VAT from customers when you do standard rated sales. In normal life, exempt sales does not qualify. Exempt sales does not qualify for any output VAT. Hope you remember I taught you, right? So how much is your output VAT? You have standard rated sales of 50,000. You have standard rated sales of 50,000, and for standard rated sales, yes, we have to calculate output VAT. Do you remember? It's inclusive. They have written inclusive. So for inclusive, you write 20 upon 120. I hope this is basically F3 topic. F3 topic. For inclusive, you have to write 20 upon 120. Come on, 50,000 into 20 upon 120 is how much? 833.3. 8333.3. Okay, this is output VAT. And then tell me the standard rated expenses. Tell me the standard rated expenses. How much was the standard rated expenses? How much was the standard rated expenses? It was 27,300. You can check. It was 27,300. So in normal VAT working, in normal VAT return working, yes, we claim input VAT on standard rated expenses. In normal VAT working, without flat rate scheme, yes, we claim input VAT. So 27,300 multiplied by 20 upon 120. 27,300 multiplied by 20 upon 120. This is the amount of input VAT. This is the amount of input VAT we are going to claim. This is the amount of input VAT we are going to claim. Wait, 27,300 divided by 6, 4,550. Okay, so can you tell me net VAT payable? Can you tell me net VAT payable? How much is the net VAT payable? Minus 833.3 is 3783. Almost 3783 is 3783. Okay, is 3783. So the answer is here is 3783. I have a question. Come on, tell me on the WhatsApp group. Tell me on the WhatsApp group. Which thing is beneficial? Which option is beneficial? Should they go for flat rate scheme, or should they avoid flat rate scheme? Tell me. Should they go for flat rate scheme or should they avoid? Avoid. Yes. Good. Because using flat rate scheme will cost you more. Using flat rate scheme will cost you more. So it's a good idea to avoid. It's a very good idea to avoid this flat rate scheme. Okay, now point number 3. Point number 3. For each of the following statement concerning the VAT flat rate scheme, select whether it is true and false. Now these questions are your enemies. I must say these are your enemies. 4 points, and if you hit one wrong, whole question is wrong. If you hit one wrong, whole question is wrong. So these are very dangerous questions. To join the scheme, true and false. To join the scheme, expected taxable turnover. Now this is purely related to law. You must memorize the law. There are some points which you have to memorize. To join the scheme, Expected taxable turnover, yes, it's 150,000, must not exceed one. But what it is written, including VAT? No, it's excluding VAT. This 150,000 limit is correct. 150,000 limit is correct. See the dodge. 150,000 limit is correct, but the real law says that this taxable turnover must be excluding. So that's why this point is false. That's why this point number one is false, just because including and excluding mistake. Number two, the scheme can only be used by small unincorporated business. No, this may apply to unincorporated as well, for incorporated companies as well. So this is again a big false. These two are false. These two are false. Then a business must leave the scheme if the total VAT inclusive turnover, total, yes, total, for leaving the scheme, the limit is total VAT inclusive. Yes, inclusive turnover exceeds to 30,000. This is true. I told you when I was teaching you, when I was teaching you flat rate scheme, I told you there are two limits, 150 and 230. So don't forget, 150 is exclusive, 150,000 is exclusive plus its taxable turnover. 150,000 is exclusive of VAT plus its taxable turnover, and 230,000 is inclusive of VAT plus it is total sales. It is total turnover. Okay. Now the last point. Before I read the last point, let me remind you something. You know, just before this slide, what I taught you. Before this slide, I taught you that even if you join flat rate scheme, even look at me, please. The last point. Even if you join the flat rate scheme, your relationship with supplier and customer will remain same. Even if you join flat rate scheme, your relationship with supplier and customer remains same. What does it mean? You will pay normal 20% VAT to supplier on buying goods, and you will still receive normal 20% output VAT from customers. Okay. Yes, when you meet government, when you meet tax department, there's a different deal, bad news and good news. But dealing with customers and suppliers remains same. I told you this. Dealing with customers and suppliers remains same. So read this last point. VAT must still be charged on standard rated sales invoices at the rate 20%. Yes, you will charge normal 20% VAT from your customers, yes, on standard rated sales, because your relationship with customers and suppliers will remain same. Your relationship with customers and suppliers will remain same. This is a very technical point. You have to think of with your brain. Okay, so now we are already 5 minutes. We have already 5 minutes crossed the actual time. But dear students, try to understand one thing, that we are doing revision sessions. F6 course, TX course is like a big river. It's a very big course, and there are very small many things, hundreds and thousands of small things. So don't expect that we'll cover everything. First of all, don't expect. Okay, right? These are just revision days, and 15 hours are nothing for this big course, right? But still, something is better than nothing. Something is better than nothing. Okay, so stay in touch on WhatsApp group, and inshallah we'll meet tomorrow. Tomorrow I'll teach you the remaining two parts, and then tomorrow we'll inshallah practice on software as well. On software we'll start the last 40 marks things like employment income, little bit capital allowances, some quick recap of trading income, some quick recap of cash basis. Okay, right? So NICs, national insurance contribution, the key points. Okay, so stay in touch. Hello. You can switch off. Okay, bye.